Hello, my name is Jeffrey Smith. I'm the Chief Instructor here at DTI. This video is about Iron Condors. Of course, there is risk in trading. We can lose money. And of course, a simple rule, if you can't afford the loss, do not take the trade. And past performance is not indicative of future results, which at times is a good thing. Other times, not so good. When looking at an Iron Condor, it's just a fancy name for doing two credit spreads. But unlike the credit spreads, when we're looking at selling a bear call spread, we want the market to move lower. When we're selling a bull put spread, we want the market to move higher. The Iron Condor actually takes both into account. We're going to actually sell two separate credit spreads. We're going to sell a call spread above the current market. We're going to sell a put spread below the current market. When we're looking at this, we really want the market not to have a directional move. We have a stock that is oscillating between two separate prices over a period of time, then we can look to sell those two credit spreads with the expectation of that same stock oscillating between those two separate prices. This is a chart of Apple. It's a daily chart of Apple. You'll notice here that Apple currently cannot get above 530, and you can't get below this 512 area. And if you kind of look at the number of bars we have here, it's been about 2 weeks in here. This was actually Apple's earnings, that big red bar here. So since that time, it's just been oscillating back and forth and back and forth. So if we look to sell a call spread above this resistance area and look to sell a put spread below this support area, then we should be able to let the time decay come in and decrease the value of those call spreads. So in this case, we would sell the 530 call and buy the 535 call. And that's the call credit spread, or the bear call spread, and which the 530 call will bring in more money than the 535 call costs. So we will have a credit on that side. Then we're going to sell the 510 put and buy the 505 put, which again, we're going to sell the 510 put, which brings in more premium than buying the 505 put. So not only are we going to take advantage of just selling one spread to bring in money into our account, we're going to actually sell two spreads to bring in money from both sides, the upside and the downside. So as long as Apple does not go above 530 and it doesn't go below 510, we will actually keep all the premium from this condor, or these two spreads. The spread value will deteriorate over time. So if we can find a stock that is oscillating between two prices, then we can look to sell two separate spreads, one a call spread, one a put spread, and be able to keep the premium. Depending on how long out the expiration is, if you're doing like weekly options, you should be able to see some deterioration over 2 or 3 days. If you're doing monthly options, it might take a week or two before you get the deterioration before you look to buy them back. You can buy them back at lower prices, you make money, or if you just let them expire worthless, then you'll make the money there as well. Thank you.